Welcome to The Chemical Show, the podcast where chemical means business. I'm your host, Victoria Meyer, bringing you stories and insights from leaders driving innovation and growth across the chemical industry. Each week, we explore key trends, real-world challenges, and the strategies that make an impact. Let's get started. Welcome back to The Chemical Show, where leaders talk business. Today, I am speaking with Kurt Barrow and Andrew Neale from S&P Global. And you guys know these guys. Kurt's been on the podcast before. This is Andrew's first time, so we're going to initiate him nicely. And both of them are going to share some insights and updates about what's the current state of the chemical markets in 2025 and what's our outlook as we start heading into 2026. So, Andrew and Kurt, welcome to The Chemical Show.
Thank you.
Thank you.
Awesome. So I'm just going to start with I'm going to ask both of you guys the same question, which is, if you think about 2025 and this wonderful world that it's been, and you had to characterize it in 3 words or less, what would it be?
I'm going to say 2 words or two phrases: dynamic and government influence.
Yeah, those are good. All right, Andrew.
I'll go from looking a little bit further downstream: volatile and continued oversupply.
Okay. All right. Well, and that's a good way to get started. So let's talk about it. Where are we currently as we sit here recording at the beginning of November 2025? And let's maybe start with the fundamentals, which is energy and oil. Kurt.
Sure. Yeah. No. I'll start at the front of the chain and let Andrew kind of pick up the pieces, as it were. Right. Listen, I said dynamic, right, and that's not just kind of this year. That's, if you look back, I guess, a little bit of history, right? If you think back 5 years, right? I mean, 5 years ago we were in COVID, and then we tried to restart the economy quite rapidly, hit some supply chain issues. More on the chemical side, actually. Oil was, supply chains were fine. We actually had the invasion of Russia, the Russian invasion of Ukraine, that obviously sent energy prices crazy in Europe, and we all know the kind of the fallout and consequences of that. I mean, but also very resilient. The energy system has proven quite resilient. We shipped 5 million barrels a day of oil halfway around the world, right, as we put in the government influenced bans, right, the original bans of oil from Europe and the U.S. And so flash forward right to today, we're still working through that, right? We've got new sanctions from the Trump administration, quite strict sanctions if they enforce them around the Rosneft Lukoil, potentially locking them and anybody who buys Russian oil out of the U.S. financial system. These are really strict sanctions that, like what we're applying to Iran, right? So fundamentally, we're oversupplied, as Andrew said, and we can come back and talk a little bit about what that means for 26. But it's also quite volatile at the same time.
Yeah. So question for you on this, Kurt, and I think about some of the conversations I was having with folks a couple of years ago that talked a lot about the supply chain influence and not so much about supply chains being broken, but the fuel standards. How is that playing out to the extent that you I saw that look on your face, to the extent that you're able to comment? I'm not hearing anybody talk about it currently. However, this must have an influence somewhere along the way.
It will. I'd say that's the whole energy transition more broadly has become more pragmatic, I guess maybe is the right term to use.
Yeah.
There's some pretty interesting shifts happening in terms of parts of the world that are actually accelerating the energy transition. That's primarily China. And then slowing, right, obviously quite dramatically in the U.S., but I think slowing in some of the OECD markets as well, right? I think if you sit and have honest conversations with some of the OECD companies in the markets in Asia, right, they'll tell you things are slowing there, even if they haven't really changed the policy documents quite yet.
Yeah. And what about the tariff picture? How are tariffs playing out when we think about energy and oil?
Primarily playing out from the demand side, right, and the risk around what does that mean for oil demand. The actual sanctions themselves, or the tariffs, I should say, the tariffs themselves, with a few exceptions. We can come back and talk about, ethane, propane into China, U.S. ethane and propane into China. That was one that had some fits and starts to it. But everywhere else, it's not really directly impacting trade. It's more about the uncertainty of other tariffs, other products, and how that plays through. It's also kind of whipsawing some of the demand because we're front running, some trade into the U.S. Ahead of known changes in tariffs, and that's playing through the petchem sector largely, but it's also affecting things like diesel demand, right, where we're seeing large freight movements, and then everything kind of slows dramatically down.
Got it. Got it. Okay, so Andrew, over to you. So let's talk chemicals. What are you seeing in the wonderful world of chemicals?
So I think piggybacking on the back of Kurt, I mean, the one thing I'd add on all of the factors that influenced us over the last couple of years coming out of COVID was that China recovery was much more dramatic in terms of delayed coming out. We saw that sort of bullwhip effect come back out through 22, 23. So that had an additional impact. But I think preceding all of that was that long, prolonged period of pretty decent returns through the teens. Ended up with a whole host of people around the world investing in capacity, primarily China, but around the rest of Southeast Asia, Middle East as well. And we're now seeing 2019, 2020, all of that capacity start to hit markets. And that hasn't changed. We're still in that, going back to the three words, continued oversupply, and we're just working that off. And I think if we look now through the middle of 2025, coming in, it was oversupplied. Q2, volatility. We saw a lot of supply chain sort of move backwards and forwards. The US couldn't export a whole host of materials out to China. Petchem wise, you saw a couple of million tons of polyethylene. Couldn't import a lot of finished goods, so we saw uncertainty and basically sort of a block on orders initially. So on a year we see demand growth. We probably lost about a quarter of our growth this year from what we were expecting beginning of year. So still growing. We're still well over sort of 10 million plus tons of base chemical demand load, but we've lost some of that growth just through some of those uncertainties.
Yeah, and I guess if I think about chemicals and the way it just ties down to the consumer, lots of mixed reports depending on which outlet you look at, et cetera. And yet the economy is certainly, the U.S. economy still seems to be holding steady. So you would assume that while there's demand growth loss, there's still just base demand that's going okay.
I mean, the fundamentals of things that people are buying day to day are still growing. Yeah. The opportunistic purchases are still not as big, and Kurt mentioned, some of our automobile buying habits are changing. We're not all jumping into the EV pool straight away, and some of those decisions are being pushed back. Inflation at 10%. I think we still do the weekly grocery shop, but we don't make those big purchases, and some of those are where houses and autos are where we're seeing that pullback, and that's just not pulling through chemical demand quite as strongly as it has been sort of previously. Yeah. Look, we expect that to recover. It's just what's driving our economy growth at the moment, and at the moment there's a lot of service led, not quite so much from the fundamentals and manufacturing side of things.
Yeah, that makes sense. And what about supply chain? And we talk a little bit about how disrupted supply chains have been. Some of it's tariff related. Is it primarily tariff, or is it physical disruptions? What are you seeing this year?
We come in with the ongoing physical disruption around the Suez. We've got congestion around the Panama in terms of our canals and shipping routes. But really, it was that container freights in and out and around Asia. So we track a container index, which is an amalgamation of all the big container freight routes around the world. And if we look at 5-year averages, Q2, June, July, we ended up sort of at a 5-year high almost, which was just, instead of going to China for that material, you're going to Vietnam, you're going to Thailand. A lot of those supply chains all shifting around. Since then, we've ended up almost at 5-year lows now. We have industry and the supply chain has reset itself pretty quickly to be able to optimize through that. And we're seeing freight rates come down. It's less for the consumer. So it's actually helping sort of what that end use cost is that's passed on to consumers and customers.
So I've heard a couple different points of view on this in terms of Q1 seemed to be kind of slow because people were trying to figure out what is actually happening from a tariff, from a economic perspective. Q2, there was better clarity about what the tariffs were, and people were moving purchases and moving ahead on business, including a couple of things I was hearing recently was about companies actually building in tariff pricing, even though they weren't realizing tariffs, but kind of pushing in pricing early to accommodate tariffs that may or may not come. And then I've heard, quite honestly, from several companies that Q3 was bad. Now, earnings reports are coming out now. It seems to be a mixed bag, but what are you hearing and seeing with your customers and folks you talk to?
I think it depends upon product and value chain. I mean, you say Q1 was it was uncertain, but we saw a whole host of benzene, for example, end up in the US through Q1 because they knew something was coming, and the US being net short took that option to move product. It meant we saw very little through Q2. Q3 has been, I think, agree on how much tariffs get passed on to customers. I mean, if we look at our economists at S&P, they're actually sort of pushing this year down a little bit to say that tariff pass on is not going quite as fast as maybe previously was expected. So that's weighing on some of our GDP views of this year, next year, on when US customers are finally going to be paying those costs.
Yeah, makes sense. Makes sense. Okay, so we've talked about kind of digging in a little bit deeper, just in terms of what the short term, what you guys are seeing here in the short term, as it relates maybe to feedstock. Let's talk about, if we play out the rest of this year and heading into first quarter, what are you seeing there, Kurt?
Yeah, so lower prices, right? And in summary, but let me put a little context around that, right? I think in the oil side, right, in the crude oil markets, we've got a lot of oil coming to market, right? We've got long duration non-OPEC projects. We got Guyana, we got Brazil, we got some Canadian oil sands, and then on top of that, right, as you know, right, OPEC Plus has made the decision to bring additional barrels into the market. That
Does
was
the market need those barrels?
No, they
Okay.
don't. They don't. Now it hasn't been totally obvious through this part of the year for a couple reasons, right? I mean, summer is the high demand period, so the gasoline season was pretty good. There was a fair bit of travel, kind of in the in many of the markets, and there was a lot of burning of fuel oil for power in the Middle East, just which is pretty seasonal, right? There was also another dynamic here that we all need to watch, and that is the stock build of oil in China. China built a significant amount of oil this year, and so that was kind of off the radar. It's not well reported. It's not something that they put out, monthly reports on oil builds or anything like
Yeah.
that. So
What would be the reason for that, Kurt? Why would they do that?
fundamentally, it's the tension between the U.S. and China is how we read this, right? I mean, China has always been very concerned about security of supply, self-reliance, and I think it's that increased tension. It's not to play that out as to where that tension might ultimately go, but the reality is, right, there is a strategic rivalry now between the U.S. and China, and so I think we're stockpiling oil kind of ahead of that because the reality is that China is actually getting close to peak oil demand, right? Because of the EVs, because of some of the other policies, they've actually been quite aggressive on energy transition, not solely for environmental reasons. A lot of it, I think, goes back to their energy security and their industrial policy, right, around making batteries, making EVs, just like they do with other clean
Yeah.
tech technologies. But anyway, they built that. But we have a really oversupplied fourth quarter this year is where we really think it hits, and then that extends into 2026, right? And that puts us in the upper 50s crude oil price, right, for next year.
So what does that do for us? What does it do what does it do to the
Yeah,
chemical
so
markets
so
and
that's
chemical
half of the
producers?
equation. So what that means is that we're going to have cheaper naphtha, right?
Okay.
So naphtha very closely tied to crude oil prices, right? The other side of the equation is the gas, particularly the U.S. natural gas, and it's actually moving the other way because of the LNG plants that we're going to be starting up, right? We have some additional increase in gas price to incentivize the drilling that's needed to fill the feed gas into those plants, and so that puts us in a 450 type gas price regime, Henry Hub, for next year. So that narrows a bit the advantage of the gas-based crackers. Still low on the cost curve, right? But it does narrow that some to the degree that that helps Andrew sell more chemicals, right? Because you get a lower feedstock price that maybe flows through, to a degree.
Yeah. Interesting. And is
So
it
I
going to
think the
help you,
two key
Andrew?
variables. Sorry, Victoria. Let me
Yeah.
add one more thing. I guess the two key uncertainties around that. One of them goes back to these Rosneft Lukoil sanctions, right? So if those are enforced in a meaningful way, enough that it would take Russian barrels off the market, we have the spare capacity. It's sitting in Saudi Arabia and a few other OPEC members, but that would be a pretty bullish signal if they had to reduce the amount of spare capacity and start pumping even more oil.
Yeah.
Um, and then the other one is OPEC Plus itself, right? They could reverse their decision to change course and take oil back out of the market at some point if they so choose.
Yeah. So, does any of this help Europe? I mean, because that's a big part of the European chemical narrative, let's say, and probably this is a narrative that cuts across industries and markets, is the high cost of energy. Of course, we know that they were dependent on Russian energy with the Russia-Ukraine war. They stopped getting a lot of that energy, that oil, the gas, et cetera. What does this do? What does more oil in markets, more production, lower prices? What does that do for Europe, if anything?
From an energy perspective, from a chemicals perspective,
How
I
about
guess
both? How
on
about both?
the
I give you guys both the chance to answer that. How's that?
okay, so from a chemicals perspective, I mean, we've already saw Europe struggle with that high energy price for a couple of years, and we've seen chemical companies one by one now start to make decisions around that, which has probably been 2, 3 years in the making, but it's gaining momentum. And now,
Yeah.
like we've seen from a cracker perspective, all of the global majors, or many of them, have all taken their high cost global asset out, which is invariable in Europe. So Dow, Exxon, even SABIC have all taken that opportunity to right size and sort of hedge trim their global cracking assets. Unsurprisingly, it's in Europe because even your derivative costs, you're trying to move that to market, your energy costs in processing and your polymers just make it unprofitable, especially in a world where the US and the Middle East has brought on so much capacity. China's become a little bit more self-sufficient in a lot of products, so that Middle Eastern and US capacity is now swinging, targeting Europe, which is a little bit of a sitting duck in many instances for some of those products. So that's kind of playing out, and that's sort of our narrative around Europe for the next couple of years. Europe has historically built itself sort of an export orientated industry to some of those small certain products, and really it's right sizing that with an energy and a gas price of where European sits. It's just not competitive to be able to push that into to markets outside of its borders.
Yeah,
Got it.
yeah, yeah. So listen, Europe's importing energy, right? They're importing crude oil, they're importing gas now, and on top of that, the policy regime there is quite constraining. They had a very forward-leaning energy transition programs. We're seeing some shifts in that, but it takes Europe moves quite slow, right? Because of the structure of how that's done through Brussels, right? I think as you go from the public opinion to the polls to the elections of the various different members in the different parts of the EU organizational structure, right? The parliament and so forth, that just takes a long time, right? So
Yeah.
Europe's really struggling in some ways beyond just the energy price, right?
Yeah, and I think that's right. And as I heard on a conference I was at last week, somebody on the panel was from Europe, a European policy wonk, I'll say. And it's, the beauty of the EU is 27 countries inside of one European Union. The downside is 27 countries inside one European Union that has to reach agreement. And that's not,
Right, right.
it's not easy to do. So obviously they've
Yeah.
got some challenges. So I'm going to come back to the kind of what we're talking about here near term. And Andrew, maybe you've already touched on this, but lower energy costs should be good. Who becomes the winners? So when you think about the chemical markets, who are the winners when we have this lower energy cost environment? Is it everyone? Is this helping the integrateds more than the non-integrateds, or is it kind of agnostic?
Those that are fully integrated On lower energy, you have an advantage if you're at the top end of that curve. You've got less. I mean, the US is going to probably lose about $200 per ton of cost advantage on an ethane-based ethylene derivative if we're looking at things like polyethylene. So that becomes less of a disadvantage for those European players. If you're going pure commodity HDPE, LLDPE, you're still not going to be able to compete from a scale perspective, from a cost perspective, but it puts a little bit more evenness in that play for those in the sort of upper Q3, Q4, lower Q4 type quartiles. Those that are still at the top of Q4 are still going to be at the top of Q4. Yeah. There's still going to be those that are price setting at plus or minus zero margin and making decisions on whether they want to run their asset through another turnaround cycle. Do they turn around for another 3-4 years? We're seeing that increasingly, questions around going into those and spending that capex or opex on maintenance.
Yeah, interesting. Okay, so if we play this out slightly longer term over the next 1 to 2 years. So, one of the things I thought was interesting, Andrew, you talked about how the investments that were being made in 2018, 2019, we're seeing them come to life and come to fruition now. One, I hear, especially Chinese assets continuing to progress and be built, heading into 2030. We've certainly seen, and these are big projects that tend to be more of the green projects, so I'm thinking about Dow's Net Zero Cracker, a lot of the sustainability projects. Those have all gotten paused, is the official wording, right? And then we're seeing a lot of rationalization. You had a nicer term for it. What do you see happening? It seems like we're in a period of structural shifts across the chemical industry.
I think a couple of things. We've gone from that globalization to regionalization. That almost helps some of your high cost players very short term. I mean, we see it when supply chains all contract, there's less opportunity a little bit. So that's a very near term. How long that lasts? Like if we have another round of tariff movements, European
and we will.
Crackers, but European
and we will. I don't know what it is, but we will.
Positive in Q2. I mean, we continue to watch. That's a very upside potential. In terms of that new wave of capacity, look, it continues to be built. I was in China a couple of weeks ago, and they took around all of that new. It's shifting to be from sort of that private to state, and there's a different focus. It's becoming a little bit more managed in the capacity that's being added. But there are still licenses that are going through, even some of those that are long delayed. We expect to get approvals. For some products, so things like aromatics, there's a little bit of a pause, and now it's not a upturn, but 26 could end up being more derivative if demand continues to grow, sort of from a polyester sort of shipping it into the US perspective or around the world. That helps a little bit. If gasoline, Kurt said gasoline was a little bit stronger. We saw pockets of that. If that stays a little, gives us some support, you end up with some opportunity. I think on the cracking side, the capacity build is still relentless, and we're going to see that matched with, over the next 12, 18 months, some more decisions around closures. If we're looking at Asia, you've got at least all of the South Korean assets. There's 2.5 to 3.5 million tons there that are going to be announced, and that's going to take a year or two to play out. You've got more in China. Their anti-involution policy sort of adds another, we think, about 6 million tons of capacity that will be taken out of the market. Now that will be replaced with more crackers, so it's not as if it's gone for good, but it's still capacity that's slowly coming out. There's probably another 1.5 million, something like that, out of Europe that we see being announced. I mean, we've seen some sale announcements or sort of discussions. There's probably a little bit more of that. There's a few crackers that are still a little bit vulnerable before 27, 28 time period, and we start to sort of reach that bottom.
So I know you guys talk to a lot of people across the industry. I know that you mentioned that this is the busy period, especially as we're all approaching year end and everybody's trying to get clarity for their strategies, get clarity and close business, all the other things. It seems to me that as older, less cost-effective assets in Europe shut down, we're obviously seeing the European base of production diminish. We're starting to see this, and you're talking about seeing this in South Korea. There's a shift, right? And so part of this was a natural growth shift, and now there's a contraction and growth shift. As you talk to executives across the industry. Is there a sentiment of concern about being globally imbalanced? I mean, I guess we've always been, if you could say it, there was a moment in time when we were evenly balanced across regions. That was probably a point in time, maybe a year. And so there's always been some imbalance, but we feel like we're moving to a period of extreme imbalance. Is this a concern when you talk to leaders across the industry, or do they just say this is about moving to low cost regions and optimizing where products are produced?
Yeah, it's an interesting question, right? Because I think there's a little bit of dichotomy there because we're talking about rationalizing assets. And I'd say the other thing, right, that we've seen, we thought this would happen, and now is consolidation, kind of ahead of rationalization, right? So we haven't seen a ton of M&A, but we've seen, places where the companies have joined joint ventures or other sort of alignments, right, to help bring a group of assets together, and then you can kind of select the ones you want, right,
Yeah.
to the weaker ones. But it is interesting dichotomy in that we are seeing maybe a bit more of an imbalance, as you say, globally, but at the same time we're seeing supply chains concern about localization of supply chains and supply chain vulnerability, kind of across the economy, right? And chemical supply chains are part of that, right? So a little early to tell, maybe from my perspective, of how that plays out. But yeah, I think it's interesting dichotomy there.
Yeah. Fair
I also
enough.
think that having oversupply and undersupply around the world, we were comfortable with that when trade barriers were low. As soon as you start to put tariffs and trade barriers in place, we're less comfortable with big supply demand imbalances around the world, and I think that's causing some shipping flows to move. I mean, we saw it very short term in the sort of Q2 as tariffs were agreed at various rates, but longer term there is that shift away from as China becomes a lot more self-sufficient in certain products. There's still somewhere we fundamentally see sort of that Middle East US flow to China will continue. That's going to impact where growth and assets keep on being closed. I think
Yeah.
that if I look at Europe a little bit, I mean some of those rationalizations we're seeing, the companies want to maintain their customer base. They're not going to be giving up those existing customers. They're just going to look to supply it from others. So some of that shift of trade flows will be companies supplying with their own material just out of US or Middle East joint ventures at a lower cost. But
Yeah.
they're going to want to, they're not going to be turning away customers next year, I don't think.
Yeah. An
That's still a fight
interesting.
for lower demand.
Yeah. And it's an interesting mix of, as you say, regionalization and globalization in a different way. So very interesting times. So we've got about 10 minutes left. Do we want to talk energy transition? Because I would say 5 years ago, we couldn't have done this without talking about an energy transition. And now maybe there's a question of what energy transition. And yet I think it's still happening just quietly.
Slower.
Yeah, it is. It is, right. And I think, I mean, this might be a good point, Victoria, just to mention, right? We are going to have the CERAWeek and WPC, the World Petrochemical Conference, in March in Houston, right? Same week, on two sides of Discovery Green Park. So a lot of what we're talking about here is a really interesting discussion around kind of what we're going to deep dive into there. But the energy transition, like I said, it's accelerating in some parts and slowing in other parts of the world and different parts of the value chain. I'd say things like electrification. If you step back and look at it at a high level, we've been relatively successful globally at electrification, but not so successful on decarbonization, right? To actually reduce emissions of our molecules, if you will, right? And again, it's going to be really interesting. The big impact on the oil side, the early big impact on the oil side has been electric vehicles. And, we're selling about 1 in 10 cars in the US is some sort of plug-in vehicle,
Yeah.
maybe 1 in 4 in Europe, and about 1 in 2 in China. The US and Europe is largely stalled out, and China continues to grow. And just like they're overbuilding capacity in chemicals and steel, concrete, they also overbuilt capacity in vehicle production broadly and electric vehicles. And we're seeing a lot of exports for those that are listening who've traveled the world. You know that
Yeah.
you oftentimes see Chinese vehicles and in Brazil, in Rio, in Thailand, Bangkok, kind of around the world. So one of the interesting things will be kind of what's China's influence of the automotive sector, and how many of those are electric vehicles versus ICE. That's a part of the transition, and then the other part, I think, coming back a little bit, maybe to the petchem side, one of the dynamics that we see is that we do have peak oil demand globally in the, call it, the 2030, 2035 timeframe, and juxtapose that with the continued growth in feedstock requirements from the chemical side. And so that means, we're going to have less refinery output to feed the chemical system. We've got a pretty detailed analysis of kind of how we think that plays out in terms of where can you go get some more naphtha molecules, right? And hit. Look at the gasoline pool, right? If
Yeah.
gasoline demand's slowing, there's a lot of naphtha in gasoline. So there's some steps like that we think will occur, but ultimately down the road, a decade or two, we need to go deeper into the crude oil barrel, and all this is to say that things like naphtha get a little more expensive, right? Or at least relative to crude oil. And so that's that's the feedstock piece of the energy transition.
Yeah.
And then, I'll
Is
let
do you
Andrew
see
talk a little
coal
bit
still
about the
playing a big role in the future? I mean, I know there was a lot of
not a
work in certain areas,
yeah,
especially coal to olefins technologies and
right,
stuff. Does
right.
that still have a role to play?
I'll let Andrew talk about the olefins side, but we do see coal generally slowing in the broader power energy side, and even the stuff they're building in China. Just as an aside, a lot of the coal-fired power you're seeing being built in China
Yeah.
is not really operated that much. It's almost like peaking coal plants. Again, it goes back to that
Got it.
energy transition or that energy security conversation around China. But Andrew, I'll let you talk to cold olefins.
I guess coal to olefins, it was something that's walking around there a couple of weeks ago. It was more surprisingly on the agenda than I thought, and especially in a world where energy transition and we see the carbon emissions coming out of a coal-based polyethylene molecule being huge.
Yeah.
They're still becoming more efficient and working on the efficiency of that. Talking around decarbonisation of that. Now that's a heavy decarbonisation program to be able to get that even on par. So in terms of new assets being built is probably more of a question mark, but certainly as part of their diversity of that security of feedstock, they see that as having a big role to play. So they kind of have that complete split. They've got the coal-based, the naphtha-based, and now the ethane-based ethylene, all within borders, all with slightly different markets as well. But there's also a huge industry and a huge part of population which is reliant upon some of those coal-based, frankly, systems, towns which are all based upon that.
Yeah. Interesting. All right. So, final question, which is 2026. I asked you to describe, 2025 in 3 words. I'll give you more than 3 words for 2026, but I guess the bottom line is, what should we be anticipating, or how should leaders and chemical companies be readying themselves for 2026? What are we looking forward to?
So I think we'll get some clarity on some things, right? So if I go back to my initial on the energy side, right? I think we'll have some clarity on the oversupplied market and how that's playing out. I think we'll have some clarity out of the White House. I mean, there'll always be some zingers and some surprises, but I think we'll know a little bit better where the geopolitics and some of the big relationships evolve to maybe some sort of steady state is maybe how I'd place
Yeah.
it on the energy side.
Andrew?
For chemicals, I would say, so going back, we've got that relief on costs a little bit. If you're a naphtha-based player, and half the olefins and all of the aromatics really are, so you've got a little bit of a relief on that. I think from a demand perspective, again, we're economics-wise, we're looking at similar GDPs 25, 26, so we're not expecting a bounce back from a demand perspective, but we're
But
equally
demand should be
not
steady. Am I right when
we're
you say
not
that?
writing off 26 demand,
Yeah.
yeah. And I think some of the capacity, we've got some value chains where capacity we don't see as much coming on next year. Maybe it's 27, 28. So there's potentially a sort of a hiatus on where that trough dips down to.
Awesome. Cool. Well, I guess good times, guys. Good times in energy and chemicals. And I know, Kurt, you already touched on this, but WPC and CERAWeek are coming up, and I know that's always a good place for leaders to learn more.
Yeah, no, it's going to be quite a show this year, right? So, like I said, it's 1 week, right, where we're both conferences will be going on, the CERAWeek in the Hilton and what we call WPC, the World Petrochemical Conference in the Hilton, right across Discovery Green, and really, yeah, just some really impactful programs. There's about 15,000 or so clients, hundreds and hundreds of our leaders in S&P Global and our analysts, right, that are all on site, really tackling all these questions, not just about markets, but technology, the geopolitics, the strategies, kind of all in. I don't know, Andrew, maybe you can give some color on the WPC program specifically.
Yeah, so I guess for WPC across the week, we're looking at strategic programs. So some of that's on specialties, how those markets are sort of maybe shaping up a little different to commodities at the moment. Circularity, it's a little bit slower than where it was 12 months ago, but there are still a whole host of companies that are interested in and pushing around that. But also things like shipping and finance, which ties. Look, it's not important just for chemicals, but it ties us into what's going on in the discussions on energy across the other side of Houston downtown. So there's that specialty piece. We have a day which is looking at our effectively pulling executives from that global sort of industries, those top executives discussing tomorrow, next decade, where we see things headed, and then the traditional sort of breaking out, into olefins, aromatics, methanol, those chemical feedstocks, where we see that changing. Still digging into China, Latin America, India, those growth regions where everybody in petrochemicals is looking for bits of optimism. So we've got a couple of sessions where we're focusing on those, and we've got individuals from producers from those countries coming to talk to us and discuss those markets. So awesome. Across the week, all of that plus plenty of networking opportunities to go and talk up and down the various sites where we are.
It's going to be exciting, and that's the week of March 23rd. Is that right?
23rd to the 27th. Yeah.
Right. All right. Awesome. Well, get to see you guys in Houston.
Yeah, I look forward to seeing you.
Awesome. All right. Well, thank you for this. Anything else we should be covering before we stop covering?
Do you have another 40 minutes, Victoria?
Oh gosh, no. That's the honest answer. Is not this month. Not for the next 6 weeks. How's that?
We can do it again in 6 weeks, and it'll be different, right?
Anyway,
just
awesome.
Rerun it.
All right. Well, good. Well, thank you both for joining me today. This has been a great conversation.
Same. Thank you.
Yeah. And thanks everyone for listening. Keep listening. Keep following. Keep sharing. And we will talk with you again soon. Thanks for joining us today on The Chemical Show. If you enjoyed this episode, be sure to subscribe, leave a review, and most importantly, share it with your friends and colleagues. For more insights, visit thechemicalshow.com and connect with us on LinkedIn. You can find me at Victoria King Meyer on LinkedIn, and you can also find us at The Chemical Show Podcast. Join us next time for more conversations and strategies shaping the future of the industry. We'll see you soon.